Okay, investors, here we go again. Interest rates are rising, and many are issuing dire warnings for you and your money. So you're probably asking, can my stocks, especially growth stocks that have led this rally, keep moving higher? Here's the key insight from our team. We want to stress this once again. Revenue growth, earnings growth, and earnings revisions, not interest rates, are currently driving this stock market rally. First off, earnings are overpowering interest rate increases so far. At this filming, the revenue growth of the S&P 500 for first quarter was 11.4%. The end of last year, that estimate for revenue growth was 8.2%. At the end of the quarter, the estimated revenue growth was 9.9%. The number came in at 11.4. Clearly, the first quarter was stronger than analysts first thought. As FactSet last data update, first quarter earnings growth was 27.7%. That was the highest level since 2021. 84% of companies beat earnings estimates. Margins are at record highs, around 14.7%, with 10 of 11 sectors showing growth, led by technology and energy, with this year's earnings set for $335 a share, and next year, 2027, at around $385 a share, and that's trending upward fast. So the bottom line for the overall S&P 500, revenue, earnings, and earnings growth is accelerating faster than interest rates are rising, offsetting some compressing valuations and PE multiple compression. Another FactSet chart showing that we are currently trading around 21 to 21.5 forward PE on the S&P 500. That's the middle of the 5-year range, even though earnings are hitting material new all-time highs and interest rates are at new yield highs not seen in 15 years. So, okay, let's understand a little bit about interest rates. We've covered this before. Remember that there are two components to those nominal interest rate yields that are constantly discussed on TV. The nominal yield equals the sum of the market's real interest rate plus inflation expectations. While many in the financial news are discussing the notion that the rise in yields is being driven by rising inflation expectation, the real-time market data is saying quite the opposite. Here's the rise in nominal yields the last 2 months. Here's that chart. And here's the recent rise in 10-year real interest rates. Okay, now let's go ahead and look at a similar graph by Alpine Macro showing their yearly rates and interest rates are driving the rise in rates here in the US, not currently inflation expectations. Well, here is the recent decline, decline in 2-year inflation break-evens. It's down and to the right since oil peaked the last week in March. Investors, everyone, we can argue and discuss that I've mismatched maturities for this example. I certainly have. But I did it to show the fast twitch nature of even bond components to real-time data. Once again, our team is trying to find real-time indicators that can help us and help our clients. We try to stay away from lagging and revised government data. Why is this makeup of the bond market good for stock investors right now? Why are real rates rising? Most likely because the economy accelerated post its first quarter slowdown. One can see this in the uptrending economic surprise index the last 6 weeks, rising from around 5 to now close to 50. This strength in the economy has led to a return to strength in growth stocks over value and industries in technology and industrial and financial transaction industries, outperforming value-based sectors like healthcare, utilities, materials, and staples. 88% of companies that have reported maintained or raised guidance, even with the turmoil in the Middle East and rising energy prices. So third, since many in the financial press have been declaring bubbles for a year or more, I'm going to return you to the bubble we've compared this to between 1997 and the first quarter of 2000. That one.com. Then and now, let's look at interest rates. Specifically, during post-long-term capital, October 1998, through the first quarter peak in 2000, the period we've discussed for about 14 months. The 10-year interest rate went from 4.5% to 6.75%. And in the last 6 months of the dot-com bubble, the interest rate rose almost 100 basis points, 1 full percent. Today, post the second quarter Tariff Tuesday tantrum last year, the 10-year interest rate has risen from 3.88% to 4.65%. More importantly, rates have risen only about 45 basis points since the stock market lows at the peak of the Iranian concerns at the end of March and first quarter 2026. While it feels bad, today's move is more measured and less disruptive for stocks. So let's go back in time and look at the oil comparison. Okay, oil prices. I'm one of the first ones to raise concern about oil prices rising. If it moves too high, too fast, historically, that puts a huge headwind for stock markets. And it has marked every major stock market peak I've ever studied. The Nifty 50 era, the dot-com bomb, great financial crisis, all had something in common. They had oil prices rising quickly and dramatically, and energy stocks leading the markets higher, with the previous bull market leaders right there up until the ultimate top. Looking back at the same period in dot-com, 1998 through 2000, oil rose 150 to 200%. Yes, off a lower base. So since Tariff Tuesday last year, now oil was around $58 a barrel. It reached a spike of about 112 to 120 for a few days at the end of March, up about 100% in 5 months. That is hurting consumer confidence in many retail industries. However, historically, oil would have to rise close to $150 a barrel or higher to cause permanent and irreparable damage to the U.S. economy and to the U.S. stock market. Today, the energy-triggered inflation impulse here in the U.S. is real. Just fill up your gas tank anywhere, but it's manageable for our stock market right now because the U.S. energy intensity is much less than it was 30 or 40 years ago, and we are much more energy independent now than then, having become a net exporter of oil and natural gas. So one last thing, I'm going to go back to some valuation metrics, old school, back when I was just learning this trade. My early days as an equity analyst. Many of the older portfolio managers in Boston had some basic math tricks they like to use. The one that stayed with me all those years is the easy valuation PE rule. Those that have watched us know I hate discussions about valuations and PEs because I don't find them very helpful at valuing equities and determining tops and bottoms. But here's the basic tool. Well, back before the internet and AI, when we were more of an asset-based economy versus an intelligent economy, the old PE rule of thumb was approximate fair PE was 1 over the 10-year Treasury yield. So the 10-year Treasury yield was 4.578% right now. The fair PE would be 21.85. That interpretation, higher interest rates equal lower fair value PEs. Lower interest rates equals higher fair value PEs. Does this make sense in today's rate environment? And where would this place the S&P 500 versus those strategist targets out here? I'm going to go back and use FactSet data again. This would say fair value right now in the S&P 500 at 21.85 times, $335 a share for this year, and 21.85 times $385 for next would be $7,317 now. And as of this writing, the S&P was at $7,319. That's pretty crazy. And next year, $8,412. Of course, should the 10-year Treasury rise more in yield and the 2027 earnings become too high, the lower end, the 385, you could quickly get a number on the S&P 500 that would cap it near 7,800 to 8,000, say 20 times $385 a share. So what's our message? While the market's valuation isn't cheap, it's not extreme when compared to interest rates or earnings growth. Earnings growth is very strong. Rates are rising from historically low levels, but not spiking. Inflation is rising secularly, but still contained relative to history, and stocks are most investors' best defense against price inflation. So what's the bottom line? Interest rates are a headwind, but not a roadblock to your equities. As a retiree or pre-retiree, we know it can be difficult to stay patient with your portfolio when financial news is designed to stir emotions. Most often, though, the best approach is to stay focused on what matters to most stocks over time, earnings and earnings growth. Right now, that's what the market is watching most closely. For now, stay disciplined, stay diversified, and focus on what's real, not what's exciting. Whether your priority is growth, income, or a combination of both, the Oak Harvest team is here to help you plan for your family's financial future, no matter where you're at in your career or in your retirement journey.